Did you know that the same 5,000 that are currently sitting in your account can be the starting point to conquer your financial freedom? Many people believe that saving money is already enough, but the truth is that without strategy, it loses value day after day. The secret lies in knowing how to use that resource the right way to protect yourself and multiply your wealth. If today you have around $5,000 saved in the bank, there's some smart actions you can take to extract the maximum value from that money. And it is precisely about that we're going to talk now. Have you ever imagined what it would be like if your salary came with a user manual? Something like, do you want to spend it all quickly? Go this way. Do you want to multiply your money? Go that way. It would be much easier, right? Even more, because nowadays, simply leaving money untouched does not have the same impact it had a few decades ago. That's why, more than ever, it is essential to learn how to manage your finances in a strategic way. The first point is to understand what the function of the money you save really is. And here comes a warning. IT will not make you rich. Unlike what many have heard all their lives, saving money is not, by itself, the path to building wealth. That happens because inflation silently eats away at the value of savings. But that does not mean you should stop saving. It only means that you need to save in the right way. The main goal of your financial reserve is not to generate wealth, but to serve as protection. It is a shield against unforeseen events. The minimum recommended is to have around $2,000 saved in an account with easy access. That amount is for basic emergencies, CAR repair, home maintenance, or a broken appliance. Having this fund already prevents you from resorting to credit cards or expensive loans. After that initial amount, the next goal is to accumulate the equivalent of 3 to 12 months of your living costs. That period varies depending on your profile. If you're willing to take more risks, you may settle for 3 to 6 months. Now, if you're more cautious and prefer safety, the ideal is 12 months. Example, if your monthly expenses are around $3,000, your reserve should be between $9,000 and $36,000. That money needs to be available, but it should not be used on impulse. Only touch it in the face of a real emergency. And a clothing sale does not count as that. Outside of that reserve, there are only 2 strong reasons to accumulate money. 1, to make a relevant purchase, such as making a down payment on a property or changing your car. 2, to take advantage of investment opportunities, such as acquiring stocks, rental properties, or other assets you're studying. If it is not for these purposes, there is no point in leaving money idle without a goal. That is because, while it sits in the account, inflation decreases your purchasing power day after day. And here goes a practical tip. Choose digital banks or online accounts that offer better returns. Many institutions without physical branches manage to pay higher rates precisely because they have lower costs. That detail, in the long run, can make a huge difference in your results. Now, let's move on to the second important point, using part of the money to pay off debts. It may seem obvious, but many people save a good amount while at the same time continue paying sky-high interest on credit cards or loans. That makes no sense. Look, while investment can yield around 10 to 12% per year, credit card debts or personal loans can easily reach 40, 60, or even more percent per year. In other words, what you earn on one side, you lose double on the other. In this case, paying off debts is, in practice, the best investment you can make. Think of it this way. Paying off a debt with interest of 50% per year is like having an immediate return of 50% on your money. It is a gain in dollars, certain and risk-free. That is why, if you have already built your emergency reserve, the next step is to free yourself from high-interest debts, mainly credit cards, overdrafts, and personal loans. As for low-interest debts, such as some subsidized student loans or mortgages, there may not be as much urgency. In that case, depending on your profile, it may be more worthwhile to invest the money and seek higher returns. But here comes an essential principle. Stop financing unnecessary things. Buying what you do not need with money you do not have is what keeps thousands of people in debt. If an expense does not bring financial return or is not truly essential, IT should not be paid in installments. And never forget, every dollar you stop paying in interest is a dollar that stays in your pocket. These are the first 2 fundamental steps for anyone who already has money saved. Build a solid reserve and eliminate expensive debts. But if you made it this far, I have 3 extra steps that will help you put your money to truly work. After all, idle money does not create freedom. In the end, what we all seek is freedom. Financial freedom to choose how to live, without depending only on the monthly paycheck. Now, If you leave the same $5,000 in an account that yields close to 100% of the basic market rate, in 1 year you will have around $5,600. That's good, but let's be honest, it's still little. Now, if part of that amount is allocated to assets that grow above inflation and truly have the potential to multiply your wealth, the game changes completely. This is the point where real investments come in. Stocks, real estate funds, ETFs, cryptocurrencies like Bitcoin, or even equipment and tools that can generate extra income, depending on your risk profile. But where to start? If you're a beginner, follow 3 simple steps. First, open an account with a serious brokerage firm, preferably one that offers 0 fees and good support for those who are just starting out. Second, invest some time to learn the basics about each type of asset. Discover how stocks, real estate funds, ETFs, and even cryptocurrencies work. It's not complicated. Studying between 15 and 30 minutes per day will already put you ahead of most people. Third, start with a little, but start now. Today you can buy a fraction of a stock with less than $10. Invest in real estate funds starting from $100, or build an ETF portfolio with affordable amounts. The important thing is not the initial size of the investment, but creating the habit of investing frequently. The shares of good companies, for example, can pay annual dividends and also appreciate over time. Real estate funds pay monthly returns. ETFs allow automatic diversification even with little money. And Bitcoin, despite the volatility, can serve as a long-term store value. But attention, this type of investment requires patience and a future-oriented vision. An example of dividing the 5,000 would be 1,000 in stocks of solid companies, 1,000 in real estate funds, 1,000 in ETFs that follow major indexes, 500 in cryptocurrencies, and the rest reserved for emergencies. It's only a suggestion, of course, but it already shows that it's possible to build a solid base even with little. And it's not only in the financial market that you can invest. There are also the so-called physical assets, which can generate income almost automatically. I know people who bought simple equipment and created new sources of income. For example, someone invested in a cotton candy machine to rent out for parties and events, and in just a few months recovered the investment. Another case is of someone who bought a used cement mixer and started renting it for small construction projects. The equipment paid for itself quickly and continues generating recurring income. This model can be replicated in many ways. A washing machine to offer laundry services, a fryer for events, a professional brush cutter for gardening, among many other options. The logic is simple. You buy something once and turn it into a continuous source of income. After you already have an emergency reserve and begin investing, the 4th step comes in. Increase your capacity to invest. Because saving and applying the 5,000 you have today is an excellent start. But that alone is not what will bring you true financial independence. The key is to transform this into a constant cycle, increasing your income and the amounts you invest month by month. That can be done with extra jobs in your free time, such as selling products online, teaching classes, providing services, or creating content. Another alternative is further training, because the more skills you develop, the more value you deliver, and the more value you deliver, the more you can charge. It's also worth rethinking your career and seeking more profitable areas, or even negotiating better conditions in your current job. And of course, all money that comes in and is not essential for the short term should be reinvested. That is how compound interest really works. The 5th and final step is to protect what you have built. Many people start well, accumulate an initial wealth, but end up losing it all due to lack of care. That's why you must stay away from miraculous promises. If someone offers 10% returns per month without risk, be suspicious. It's probably a fraud. In addition, take care of your physical and mental health. It's useless to accumulate money if quality of life disappears. And be prepared to deal with something that almost nobody talks about: boredom. Investing, in practice, is a slow process. You may spend years watching your wealth grow little by little, and during that time you'll be constantly tempted to speed things up by making bad decisions. The winners in this game are those who have patience. In summary, if you have 5,000 saved, that amount could be the starting point for something much bigger. Use a portion to build an emergency reserve, eliminate expensive debts, begin investing with strategy and consistency, seek to increase your income, and protect what you're building. If you follow these steps, those 5,000 will not just be money saved. They will be the beginning of your journey to achieving financial freedom, not because of the amount itself, but because of the mindset shift it represents. Well, I hope this content made sense to you. See you in the next video.